Hey money friends, welcome back. So how would you like to retire? Picture yourself waking up on a sunny Monday, sipping coffee, knowing that every bill is covered, every dream is within reach. What kind of return should I expect? How much work will this be, and what's actually passive income? Don't worry, we're here to break down these two investment strategies so you can decide which fits best for you. Unlike salaries that depend on working hours, rental income comes from owning the property. To start investing in rental properties, you'll need a significant amount of money for the down payment, closing costs, and initial repairs. This high upfront investment can be a barrier for many people. Second, property management. Managing a rental property can be a full-time job. Companies may reduce or eliminate their dividend payments during economic downturns or if they face financial challenges. This can impact your income and investment returns. Second, reliance on company performance. Dividend-paying stocks rely heavily on the performance of individual companies. According to the National Association of Realtors, the median return on investment for rental properties in 2023 was 10.7%. This means that for every $1,000 invested in a rental property, you could earn around $107 in annual profits. Do your research, consult with a financial advisor, and make informed decisions based on your individual circumstances. Remember, the best option depends on your unique situation and goals. Before you go, like the video and share it with someone who might find it useful. And let us know in the comments. Are you team real estate or team dividends? Thanks for watching. Keep learning, keep investing. Whether you choose to invest in rental properties, dividend-paying stocks, or a combination of both. The most important thing is to start early, stay consistent, and be patient. Over time, your investment will grow, and you'll be on your way to building wealth and securing your financial future. However, it's important to note that rental property returns can vary widely depending on factors like location, property type, and market conditions. The biggest benefit of real estate is that it's tangible. You own a physical asset that can provide you with a sense of security. Unlike stocks or bonds, you have a physical property that you can see and touch. This tangibility can be appealing to many investors who prefer to have a tangible asset rather than a purely abstract one. Additionally, real estate tends to hold its value relatively well during times of economic uncertainty. While stock values can fluctuate significantly in response to market conditions, real estate prices often remain relatively stable. If a key company underperforms or faces issues, it can affect your portfolio's profitability. So there's no one-size-fits-all answer. Consider your financial situation, investment goals, and personal preferences before deciding which path to choose. It's also possible to do both. Many successful investors build a mix of rental properties and dividend-paying stocks in their portfolios. They diversify their investments across different asset classes to maximize returns and minimize risk. By combining the benefits of both, you can create a well-rounded investment strategy. Third, volatility. Although dividends provide some stability, the prices of dividend-paying stocks can still be volatile. Market fluctuations and investor sentiment can cause price swings that may not align with your long-term investment strategy. Fourth, opportunity cost. Investing in dividend stocks may mean missing out on the potential returns of other investments, such as high-growth tech companies or alternative asset classes. And fifth, required investment. While starting small is possible, achieving significant dividend income often requires a substantial investment portfolio. Building a diverse portfolio of dividend-paying stocks can take time and dedication. From finding tenants to collecting rent and handling repairs, it takes time and effort. If you don't have the necessary resources or expertise, it can become overwhelming. It's great for those who want lower risk, prefer online investing, or seek more passive income. For example, the S&P 500 Index Fund has historically paid a dividend yield of around 1.5%. This means that for every $1,000 invested, you could earn around $15 annually in dividends. And over time, this income can grow as your investment portfolio appreciates. Of course, past performance is not indicative of future results, but it gives you an idea of the potential returns you could expect. Remember, dividend investing focuses on long-term growth and income generation. It's about building a diversified portfolio of companies that have a track record of paying dividends. and have the potential to increase those payments over time. Third, tenant issues. Dealing with difficult tenants can be stressful and costly. From late rent payments to property damage, you could face various challenges that impact your income and the condition of your property. Fourth, unexpected expenses. As a rental property owner, you must be prepared for unexpected expenses such as major repairs or vacancies. These costs can strain your finances and affect your profitability. And finally, illiquidity. Unlike stocks, real estate is not easily liquidated. This means that if you need to sell your property quickly, you may have to sell it at a loss. The selling process can also be lengthy and involve significant transaction costs. Once you've made the initial investment, you'll receive regular rental payments, creating a reliable source of revenue. Investing in dividend-paying stocks can be another great way to build wealth and earn passive income. Here are the pros and cons. Second, potential for appreciation. Property values tend to appreciate over time. As the property increases in value, so does your investment. This makes it accessible to a wide range of investors, including beginners. Second, diversification. It's easy to diversify your portfolio across various companies and sectors. This spreads your risk and reduces the impact of any single stock's performance on your overall portfolio. Third, liquidity. Stocks are highly liquid, meaning you can buy and sell them quickly. This gives you the flexibility to adjust your portfolio based on changing circumstances or investment goals. Fourth, professional management. When you invest in established companies with a history of paying dividends, you benefit from the expertise of their management team. These companies have professionals dedicated to making smart decisions that drive profitability and shareholder value. Fifth, accessibility. You can invest in dividend-paying stocks from anywhere in the world. With online brokerage accounts, global markets are just a few clicks away, allowing you to build a diverse portfolio without geographical limitations. And finally, compounding returns. Dividend investing allows you to reinvest your dividends, earning more dividends on your investment over time. This compounding effect can significantly boost your returns, leading to exponential growth in your investment portfolio. This means that besides rental income, you can benefit from long-term growth. Third, tax advantages. There are several tax deductions available to rental property owners. These include mortgage interest, property taxes, insurance, repairs, and depreciation. These benefits can significantly reduce your taxable income and make owning rental property more profitable. Fourth, inflation hedge. Rental income often keeps pace with inflation. As the cost of living rises, so does the demand for rental properties. This means that your rental income may increase, along with inflation, helping to maintain your purchasing power. And finally, leverage. With rental properties, you can use leverage to your advantage. This means borrowing money to finance the purchase of the property. By doing so, you can amplify your returns as the property appreciates and generates income, allowing you to build wealth faster. You have options. You have freedom. This is the retirement most of us dream of. But how do we get there? We've been talking about building wealth and passive income for a while now. Two common paths to that dream retirement are through dividend investing and rental properties. Both can bring in steady cash flow and watch your net worth grow. Oh, which one is really better? If you're thinking of building passive income or investing in property, you probably have questions. How much money do I really need? First, let's look at rental properties. Owning rental properties can be a great way to build wealth and earn passive income. Here are the pros and cons to consider. Starting with the good stuff. First, rental properties can provide a steady stream of income. But as with any investment, there are downsides. Here are the cons of rental properties. First, high initial investment. Now let's shift our focus to dividend investing. First, low barrier to entry. With dividend investing, you can start small, often with just a few dollars. But let's talk about some of the downsides. First, dividend cuts. So which one is right for you? Ultimately, the choice between rental properties and dividend investing depends on your individual circumstances, preferences, and goals. Let's start with the clear winner, dividend investing. Now let's talk about real estate. It's great for those who want more control, higher returns, or tax benefits. As you can see, both dividend investing and rental properties have their pros and cons. As always, Remember that investing involves risks, and past performance is not indicative of future results. We hope this has been helpful in deciding whether to pursue rental properties, dividend investing, or both.